Black Swan author Nicholar Nassim Taleb is launching a fund betting on a rise in inflation that few might expect. As governments continue to ramp up the printing presses, throwing money at the economy, the Black Swan Protection Protocol Inflation Fund will invest in options tied to commodities and stocks such as miners and oil drillers. And meanwhile, that's ahead of course, central banks and their unconventional methods being in focus later this week, again ahead of the ECB and Bank of England monetary policy meetings. So are we heading down a path of potential much higher inflation, or are our fears overdone? Joining us for more, Willem Buiter, Professor of European Political Economy at the London School of Economics, former MPC member, of course, and Neil is still with us. Willem, join us on this discussion here. No inflation this year, and Neil said maybe not at the beginning of next year. What are your fears about how much we might be putting into the system in terms of future inflation because of central bank actions at the moment?
No, central bank actions in monetizing large amounts of bad private debt and, going forward, large amounts of public debt will only be non-inflationary when the economy begins to recover if they can be reversed.
The exit strategy.
Yeah, exactly. And they can only be reversed if the government has the fiscal means and the political will to use those fiscal means to reverse them, to have future tax increases and spending cuts. I don't see that in the US at all. I have doubts about the UK. I am more confident that the ECB will, if necessary, just dump the stuff out of the euro tower and to monetize. So I can see a differential inflation risk, but certainly in the US and to a slightly lesser degree in the UK, because the government is so much, the executive is so much stronger there than it is in the US. It can impose pain more easily in principle. But for the US, I think it's a foregone conclusion. The kind of debts that are about to be accumulated by the US have never been amortized through surpluses or growth alone in the past. They've always been inflation, indeed unanticipated inflation. And given the inability of the US political system to achieve a consensus on future tax cuts, tax increases, which will be vetoed by the Republicans, or future spending cuts, which will be vetoed by the Democrats, I think there is no solution that does not involve a sharp increase in inflation. Some distance down the road may have deflation first, right, negative inflation, but inflation will almost surely come.
I mean, how long might it be down the road?
3 to 5 years.
Right.
Well?
Martin?
Well, this is, again, where I don't want you guys to explain this to me because my own head still can't seem to get around the idea. Firstly, again, I go back to the experience of Japan, which executed quantitative easing in similar percentages to what we're seeing now, and we don't have any evidence at all of inflation, let alone hyperinflation. And that's the first point. Second point is the broadest measure of money in the United States already includes the public debt in terms of the treasuries. So if you just, is it not? I mean, are you not simply just exchanging the composition of broad money rather than increasing broad money, i.e. by purchasing a treasury and changing it for cash?
No, no definition of money, as far as I know, includes treasury. No, it may be that there's an M16 out there that includes, that includes treasuries, but no. No, treasury debt is non-monetary debt. It tends to be held. Money is things that tends to be spent. And that's why, especially the money created by the central bank, base money, which is the most highly liquid form of wealth, is a potential inflationary threat. The reason that Japan never saw inflation is that Japan never had a proper recovery. They never closed the output gap. They have been in recession in terms of being below capacity, even though they have grown in years up to 2007.
Of growth in the early 2000s.
Yes, they did,
about 5 years.
but they never made up the gap to potential that built up during the lost decade. So, and they still, I think, are at a situation that much of its industry could produce at much higher levels than they have been doing. So Japan also had never a recovery of confidence of portfolio holders who go, when they get their confidence back, switch out of money into more interesting assets.
But the circumstances, I suppose, in the UK could be similar. I mean, we'd have to grow at 3% from 2012 for 3 straight years to get back to the level that we left in 2008. So we may not make up that gap either. That would
if you never make up the gap, you're not going to get inflation.
Exactly.
But the odds are that our economies are rather more flexible in terms of ability to recover than the Japanese, but not flexible on the fiscal side in terms of the ability to recoup the debt.
The lesson of history is pretty clear here. If you run up debts in the way that we're currently seeing, if you run deficits equivalent to 13% of gross domestic product, if you end up with a debt-GDP ratio of 100% or more, and it likely will be more in the United States within a 5 to 10 year time frame, then it's extremely hard to exit from that position without some modicum of inflation. I think the parallel with Japan is really misleading here, because there are profound differences between the Anglo-Saxon world and the Japanese world, not least the age structure of the population, the very nature of capital markets. No, I think we also need to bear in mind that there will be destruction of capacity in this crisis. And I think some of these output gap measures
will be permanently taken out of the system.
I'm not sure I entirely believe some of these measures of the output gap, and I think we should be aware of what will turn out to be a rather smaller gap to be closed, particularly in the US. I mean, I think the inflation will pick up there first, not least because of the magnitude and speed of the policy response. It's been much quicker, the Fed has been much more aggressive, and there's much more quantitative easing going on here much sooner than happened in Japan.
To be fair, though, we're not going to, I presume, going to see almost zero wage inflation here. I mean, this is going to be inflation that isn't about employers getting a share. I mean, the company profits presumably will be made at the expense, yet again, of those of the workers.
But we will see, I think, in the US, continued declines once this, even when this contraction is over, in the share of wages in gross domestic product. And that is simply because the world is still a capital scarce and labor surplus economy, following the entry and continuing entry of hundreds of millions of Chinese and Indians into the integrated global economy. There's still legions waiting on the margin of this economy, hungry to get in. So yes, but that will happen, wages lagging behind prices, whether they're rising or falling on average. That is, the inflationary phenomenon is driven by central banks that cannot reverse earlier monetization of public debt because of political pressure. And there the Fed is the most suspect line of defense, because they have the least independence of any leading central bank.
I'll take a pause there. What I'd love to do is get an idea from you both of where you think that means interest rates and bond yields might be going in 2, 3, 4 years.